An all-out war broke out this week between the big hedge funds and small individual investors like you and me. This is a great interview, folks. Jim Bianco joins us to explain how the little guy finally stood up to the Wall Street cartel and how this may change everything going forward.
Let me not mince words here. This greatly upset Wall Street. This greatly upset CNBC. It's been sickening to watch it the last couple of days, how they've been defending the hedge funds and just impugning this retail investor because they're not sophisticated, talking down to them. They don't know what they're doing. Hey, they didn't lose 100% of their money. Melvin Capital did. So, let's talk about who the sophisticated investor here is in this mix.
Welcome to Peak Prosperity. I'm Peak Prosperity co-founder Adam Taggart here, welcoming you back for another week of making sense of money and the markets. And what a week it has been. We're going to jump into that with today's guest, who we are incredibly privileged to have. That is the excellent Jim Bianco, who is the president and macro strategist at Bianco Research. Fiercely independent, Jim is famous for his objective, incisive commentary that challenges the consensus thinking across monetary policy, the intersection of markets and politics, the role of government in the economy, fund flows, and positioning in the financial markets. Jim, it's such an honor to have you join us today.
Thanks for having me.
Well, let's dive into things here. Look, there's a massive insurrection going on in the markets this week with the retail investors of the Wall Street Beats crowd, the Robin Hood crowds, taking on the hedge fund industry and drawing real blood. Today, we've actually seen the empire strikes back, and we're going to get into the details of all of that next. But right before we do, I just want to zoom up to a macro level. We've seen the sharpest market recovery, not economic recovery, mind you, in history over the past year, with financial asset prices now trading at all-time highs less than a year after the 35% drop they took during the arrival of the COVID crisis last March. There are many highly respected veteran investors like Warren Buffett and Charlie Munger, Jeremy Grantham, Seth Klarman, Carl Icahn. The list is getting longer and longer every day, who are issuing warnings that the market is now recklessly euphoric. In fact, even the IMF, who is often very late to the game and conservative, just issued a warning yesterday about the rampant complacency in today's markets that it believes is obscuring the true risks. So what is your view here? Is the market repricing risk at this time? Or do you think that today's valuations are sustainable?
Well, today's valuations, just to put these numbers in perspective, are about as high as we've ever seen. My favorite metric is what's called the Buffett indicator, market cap to GDP. GDP came out today, the day we're talking, and it hit 200, a new all-time high, taking out the March 2000 high as well. The forward price earnings ratios, standard metrics Wall Street uses, they're back to 2000 bubble peaks. So this market is as overvalued or as fully valued, if I was to use the Wall Street euphemism for overvalued, that you will ever find right now. I like to say, I've been saying this lately, that everything in Wall Street is a good idea, but then they take it to an extreme. The idea that the economy was going to recover because we were going to get a vaccine, we're going to get vaccines, we're going to get some kind of return to normalcy, that makes sense. Okay, fine. But then we have to take it to an extreme, and we wind up with the valuations in the market being at the highest that they've ever been. And I think that does pose a real risk for the market moving forward. The problem with valuations is they're not timing tools. So if somebody said, as I said, oh, the stock market's at the same bubble peaks it was at March of 2000, your mind goes, oh, that means then we're about to crash and fall right away. But I could also have said it's at the same bubble peaks as it was in January of 99. And the NASDAQ went up another 80% before it crashed as well. So you don't know where you are in that mix, but you're somewhere in there, so that what the valuation tells me doesn't tell me when the market's going to turn, but it tells me when it does turn, it's got a lot of downside risk. If you disappoint a market this highly valued, that you have a lot more downside than you would if you had a cheap market and you disappointed it.
All right, and I apologize for kind of putting you on the spot early in the interview here, but I'm curious because you mentioned, downsides. Jeremy Grantham gave kind of a recap of kind of historical previous bubble valuation periods and said, we've never seen a bull market get to this level of mania without it correcting by at least 50%. We had David Hunter on this program a few weeks ago, who was sort of putting a flag in the ground of somewhere between 65 to 80%. Do you have any sort of general gut sense of the magnitude that based on the current valuations today, you think the market should correct based upon your knowledge of history?
It's hard to put a number on it because I don't really do that. But let me answer the question this way. There's other environmental factors that have to come into play with this as well, too. You've got the 10-year yield at, say, 1%, 105 or so, just slightly above 1%. If you start a correction in the market in the wake of higher interest rates were to start up, I think that's much worse than if you were to start a correction with the interest rates falling yet again, as we've normally seen. Interest rates rising, most likely my guess would be because there's be somewhat of a fear of inflation. Look, if you keep mailing everybody money, which is what we've been doing, eventually they're going to start spending it and we're going to wind up with inflation. And that could make it worse than if you were to just say interest rates are going to stay at these levels or kind of trend lower and the stock market's going to start to pull back on valuation. So tell me what interest rates are going to do and I'll tell you how much it's going to pull back. But in either case, I do think it's going to be significant. That the pullback would have to be at least 20%. It's not going to be a 5 or 10% correction, and it could be much more depending on what some of those environmental factors do.
Okay, great. Very helpful answer. Exactly what I was looking for. And just for comparison for viewers, if you're trying to compare kind of today's market overvaluation to say, prior to the 2008 great financial crisis or the dot-com boom, to Jim's point, interest rates were a lot higher there, right? And so they had the Federal Reserve had a lot of room to kind of bring them down to help cope with this. We have much less room to play with here now with interest rates. And as Jim said, kind of the other different dynamic here is that I think the concern of inflation is much higher. So if there's not a lot of room to bring rates down, and in fact, there's increasing concern rates may be going up, this could be a very different type of bubble correction than folks have experienced in living memory. All right, well, Jim, let's get on to the story of the day. And I'd love for you to really describe this better than I, because I think you're a lot closer to it. But basically, we've had sort of a David and Goliath battle going on in the stock market over the past just week or two, where you've had just legions of small individual retail investors band together to take on the big hedge funds. And they've actually done a lot of damage. I saw one estimate that it may not be due to exactly what's happened in the past week or two, but that hedge funds have experienced losses of like around 70 billion so far just in 2021 alone, which is a huge number. But basically what's been going on is these legions of retail investors have found these companies, a lot of them not really very good companies, or companies with good prospects that have been heavily shorted by the hedge funds. And they've gone in and they've been able to force the price of those companies up, causing the hedge funds to have to cover their shorts, which makes the retail investors buy in more. And basically the prices are getting driven way, way up, creating these huge losses for the hedge funds, but huge gains for these retail investors. And then today, it looks like the empire struck back. And I'll leave that dangling out there, just so when you explain this, you can kind of tell people what's happened and based on the last couple hours, what's happening now in the story. But what do we need to know about what's going on here?
Let's start with the big picture. In the last couple of years, well, first of all, for the last 20 years, we have had an explosion of technology and an explosion of communication and connectivity. Our interview right now is a good example of that. Retail investors have, through the internet, pretty much all the information that sophisticated investors, and I hate that phrase, and I'll tell you why in a second, sophisticated investors have, so they're not at an information disadvantage. Well, they were at a cost disadvantage. But by 2019, a lot of the brokerage firms have cut their commissions to zero, free, no trading commissions. Okay, they had an account size disadvantage. Well, starting last year, they allowed fractional shares. to use one example, if you can't afford $3,300 to buy Amazon stock, you could buy a tenth of it for $330. So now you don't have that disadvantage either. Well, they didn't have money. Okay, well, the government came in and they mailed them money through the Stimulus Act as well too. They didn't have the time on their hands. Well, the pandemic gave them the time on their hands, so they were sitting home. So a lot of these people started their accounts with a couple $1,000s down to a couple of $100, and they found a venue to discuss what they were discussing, or a venue to discuss investing through social media. The one that we're all talking about this week is the Reddit forum Wall Street Bets, but there's FinTwit on Twitter. There's plenty of forums on LinkedIn as well too that you could discuss investing. Then let's throw in one other thing too. The public has been very dissatisfied with the products that institutional investors have been giving them. Oh, here's a very high-priced, actively managed mutual fund which charges lots of fees and always underperforms the market. Now, I don't want that anymore. Okay, here is a low-priced index ETF tied to a broad-based index. Does better than the high-priced active manager, but the problem with the index is it's missing. Now, I'm talking about from the retail investor's point of view, it's missing an important component. The economy is going through a big disruptive change. A lot of these disruptive companies are these small speculative tech companies. These companies are not liked by Wall Street. Tesla being the big example. Everybody hated Tesla, ran up to $800. Who was buying Tesla? The public was buying Tesla. Public won on that. So they soured on these institutional investments and they said, that's it. I've got the information. It doesn't cost me anything to trade. I don't have account limits and I've got some money. I'm going to do it myself. And they started doing it themselves. One of the first wins that we saw the public do was back in May. Warren Buffett sold his airlines and said, I wish the airlines well. That's exactly what his comment was after he sold them. The public jumped in, bought the airlines, and they doubled in price within a month after Buffett sold his airlines as well. Then the public stepped in and started buying the work from home stocks. They took off. Then they bought Tesla, as I mentioned before. It took off as well too. They've been buying these speculative technology companies, or Goldman Sachs has an index called the non-profitable tech index. It's up 400% this year. So what I want to point out here is the public's experience, at least since the spring, has been win, 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 is basically what's been happening. Now you get to recent period. And you get to something like the Reddit board on Wall Street Bets. They're looking around for another opportunity. And some of the commentators on Wall Street Bets said, look at these stocks that Wall Street is shorting. They're out of control. Now, you take a company like GameStop, and GameStop is a brick and mortar retailer that sells the physical box where you can buy a video game. And a lot of people are saying that business is done and you log in and you get your games. You don't need to go drive down to a store and get it. They're going to go out of business. Okay, I get that story, no problem. But Wall Street wound up shorting 140% of GameStop. Now, what that means is they shorted more shares than actually existed. That is illegal. That is a naked short. That is shorting a share. Shorting a share is basically selling it first, buying it back later. But if I sell it to you, I actually have to physically deliver you a share. I have to borrow an existing share and deliver it to you. So that keeps the amount of shorting limited to, at the very most, the amount of shares outstanding. But if I just sell it and never deliver it, that's a naked short. That was one of the causes of the 29 crash. And one of the very reasons we created the SEC was to prevent that kind of stuff from happening. Well, obviously, the FCC is not doing their job. They're not doing their job in a lot of ways, but this is one of the ways they're not doing it. So you're looking at this and going, the positioning of these hedge funds in these shorts is made these hedge funds vulnerable to being squeezed. Well, why doesn't another hedge fund or an investment bank or a commercial bank say, you know what, we can make a lot of money. We can stick it to these guys here with these shorts. They're all in this together. nobody wants to upset the apple cart for anybody else. So while the shorts have put this one-sided bet out there and left themselves vulnerable, their arrogance was, well, who's going to do anything about it? And even if there is a rogue hedge fund or two out here that wants to do something about it, wait till Goldman Sachs finds out you're trying to upset the apple cart. They'll slam you down and shut you down for good. Well, we found a gigantic audience that was ready to do something about this. That's the retail investor. And that was, they explained this story. And you know, everybody focuses on the GameStop fundamentals. Yes, they're poor, but it was the positioning that got the attention, that they left themselves vulnerable. Hey, if we all get together and we use options too for some leverage, and we start buying these stocks, we're going to force a gigantic short squeeze on these companies, forcing the price up, forcing them to put up more and more margin, or being forced to buy in the stock, sending the price to the moon. And then, you know what will happen after we do that? When the price of the company goes up a whole bunch, they'll issue more stock, dilute the stockholders, but who cares? They're up, and improve their financial position, further squeezing the shorts. And that's exactly what they did. The problem was the law was broken on these shorts. They were doing a poor risk management job, these hedge funds, on these shorts, but they were so arrogant, no one's going to do anything about this. So we will then just put this short out, and then we'll start bad-mouthing the company to try and drive it into bankruptcy faster than it maybe would have gone, or maybe not. But we're going to try and drive it into bankruptcy to make money. And then an entity came along and started to play against them. And let me not mince words here. This greatly upset Wall Street. This greatly upset CNBC. It's been sickening to watch it the last couple of days, how they've been defending the hedge funds and just impugning this retail investor because they're not sophisticated, talking down to them. They don't know what they're doing. Hey, they didn't lose 100% of their money. Melvin Capital did. So, you know, let's talk about who the sophisticated investor here is in this mix right now. And they've been telling them that they're at risk, they're at risk, they're at risk. And then today, you're right, the empire struck back. Thomas Petterfy, who is the chairman of Interactive Brokers, right before I came on with you, was interviewed on I'm sorry, not on CNBC, but on Bloomberg TV. I know he was also interviewed on CNBC earlier in the day, but I didn't see that interview. I saw the Bloomberg interview. I love these 80-year-old founder chairman guys. They have no filter, so they just tell you what you think. And he basically said the brokers and the regulators all talked to each other, and they said that they didn't see any reason for the short squeeze to stop. So the prices were going to keep going and going and going. And they were at risk of losses, that the losses would get so great that some of the people would not pay the broker, then the broker would be on the hook. So they put restrictions on buying these stocks anymore. And then, of course, the prices started to fall. Well, of course, if you don't allow anybody to buy a stock, and you only allow them to either short it or to liquidate, guess what? The price is going to go down. And that's what's happened. But what he left out of that was, who was at risk, Thomas, of losing money? Wasn't the Reddit retail crowd. It was the professional hedge fund that was shorting these stocks. That was who is at risk at it. And you were so worried that they might be bankrupted that you stopped this cold before it got out of hand as well. Would you have done it the other way around if the hedge funds were winning? It's like I said, the wrong people made money on this. And this is what greatly upset everybody as far as how this has been working. So this is yet another example of how the public has been upset with institutional investors and has been doing it themselves and has been winning. And when you say the empire strikes back, I've been thinking more along the lines, I'm in Chicago. I live urban, very, very urban. And I've seen, firsthand the move when Uber came, the ride sharing services came to the big cities. And the taxi drivers first mocked it, kind of like Wall Street is mocking retail. Then they got really mad at it, kind of like Wall Street did. Then the taxi drivers started flipping over the Uber cars and lighting them on fire. Well, that's essentially what Wall Street is doing today to retail investors. But in the end, the taxis lost to Uber. And I fear that if Wall Street doesn't recognize, the problem is you're giving them an index fund they don't like, or you're giving them an active manager they don't like. They don't like your products. They're doing it on themselves. So instead of flipping their cars over and lighting them on fire out of anger, why don't you give them the product that they want? Why don't you give them the investment vehicles that they want so they don't feel a need to kind of go on it by themselves? So to me, what I'm trying to argue here is this is a failure of the institutional business is what this is. This is not a sign of the retail business. Retail is always there. Retail puts their money in mutual funds, puts their money in ETFs. Now they're doing it themselves. So that's really what's been happening with this. So it's not like there's new money in the market. There's a little bit of new money in the market because of the CARES Act and some of the stimulus kind of putting these money in there. And there's a little bit more new money in the market because trading costs have become so low that people are opening brokerage accounts with a few $100s and starting to play with this. But in essence, it marks a failure of we institutions will offer retail product to buy, and they don't want it anymore. And so they're going out and they're sort of creating the product on their own, kind of like a ride sharing type of thing. And the institutions are getting very upset with this because the wrong people are making money. And so it really is a very telling story. I don't think it's just more, it's more than just a mania. Is there a mania in there? Absolutely. Could prices peak and go down? Absolutely. But if Wall Street thinks that, oh yeah, there'll be a mania and these people will get their comeuppance and then they'll close all of their Robinhood accounts and they'll apologize and they'll go back to those big active managers or they'll go back to BlackRock and say, I'm really, really sorry. Here's my money. Please put it in your expensively feed fund and underperform the S&P for me, just like we used to do. That's really what I want now all over again. I'm sorry for ever thinking I could do this on my own. That's not going to happen. That is just not going to happen. We're moving in that different direction. And instead of being upset and trying to punish people for doing this, Wall Street should be understanding this switch, but they're not. So that's my little soliloquy on what's been happening over the last couple of days. And I think that that's important to understand it from the failure of the institutional side, because I don't hear a lot of people talking about it in that respect.
Yeah, well, look, Jim, that was a phenomenal summary. So thank you. And mania concerns aside for a second, I agree with you. This really is a story of disruption, right? A business model disruption. And you used, I think, a really apt analogy with Uber and the taxi medallion holders. Here, what we're seeing is and we've complained about this for years and years and years at Peak Prosperity is, Wall Street essentially has been run as a cartel, right? Few players kind of control all the action. They bend the rules to their self-interests. They compromise the regulators. They control the politicians, and they all kind of play the game. Like you said, as long as everybody's not, the game players aren't trying to upset the apple cart, everyone's going to get fat in that game, right? And of course, the patsy there is the dumb money, the small retail investors, the pension funds, et cetera. And here we go, because of technology breakthroughs and a few other things that you already listed. All of a sudden, there's enough people power to have another player in the game. And in many ways, I'm sort of watching this with a lot of Schadenfreude. Sounds like you are too, where these big bullies who have been pushing people around the playground for decades really finally got punched in the nose, right? And I think that's a really good thing for the market, in the sense that, you mentioned the SEC just really isn't doing its job. I mean, these are the 140% short positions. I mean, these things are supposed to be illegal. And this is basically sort of citizen vigilantism, where they've been able to kind of rise up and say, well, look, if the regulators aren't going to do their job, we're going to basically force a more equitable outcome here in the market. So, in one sense, I'm cheering on a lot of this stuff. But I guess the overall question I have for you, and maybe it's a very gray answer, but is this newfound power of the people here, is it a good thing for the market? I mean, I think it is for some of the reasons I mentioned, but then you also sort of have other concerns, which is, if these masses of people realize they can kind of make a company's stock price whatever they want it to be, if enough of them mobilize, is that sending kind of a bad message at this point? But I'm just curious. There's so much dust in the air right now. What do you think?
Yeah, keep in mind what made this work, what makes this work is the vulnerability that Wall Street left themselves with. when you short, like I said, they had their positionings all wrong. They had way too much short in these companies, so that somebody said they're vulnerable, that if we push the stock price up, it'll become self-feeding and just we'll force them to buy in, and then it'll just keep going and going and going. In the olden days, we used to say that there was no honor among thieves on Wall Street, that if a bunch of hedge funds did this, tried to go 140% short of a company, say 20 years ago or 30 years ago, Goldman Sachs would have looked at it and said, man, we could rip these guys off. We could take all their money from them. Let's go do that. But today, Goldman Sachs isn't the slightest bit interested in doing anything like that because they're all playing the game together. So this new crowd came in and had to do it. And so somebody's got to keep them honest. And so at least we've got somebody keeping them honest. Let me defend them, the retail crowd, one other quick way. They got a phrase on Wall Street Bets, which I think is wonderful. It's called loss porn, P-O-R-N, loss porn. Don't go on there and brag about how good you are. Don't go on there and tell me about all your winners. I want you to tell me about your losing trades. I want you to show me your losing trade tickets, and we're going to celebrate your losing trade tickets. And all their options trades, they call them YOLOs. You only live once, kind of the new wave of Carpe Diem, is basically what they're trying to tell people is this is really high risk. This is really high reward. And look at this loss porn. This is what could happen to you. If you're willing to accept those rules, then come on in and play. But we are not sugarcoating this, that somehow this is the road to riches and everything else. So in that respect, I think it's good for now because there's going to finally be a counterbalance to some of this other stuff. Eventually, if they become too big a counterbalance, then we need a counterbalance to them as well too. But that's down the road for right now. So I'm all for it. And yeah, let me be clear on this. That's not to argue that there isn't some kind of overvaluation or a bubble or some kind of a pullback. That could happen. But what I think, if you think, oh, well, the pullback will come and Wall Street Bets will close and everybody will go away. No, they won't. They'll get hurt. They'll have losses. They'll change their tactics, but they're not going to go away. And that's the part I think that people need to understand. Nor do I really want them to go away, because somebody's got to offset this cabal of Wall Street that kind of does things without any consequences, and everybody's kind of playing the game so that they benefit themselves. Look at today. Like I said, who was at risk for loss today that they had to stop the short squeeze? Oh, the hedge funds. That's who the risk was. Wasn't the public as well. And they came in and they shut it all down today in order to try and protect themselves. So we need that kind of counterbalance. This is the last word on this story has not been written.
All right. And I'm going to ask you in a little bit about some of your work on COVID. But just to make an analogy, we knew COVID was beginning to be a problem, in late January, early February. The U.S. was still letting in flights from China in March, right? Yet it took less than 24 hours for the powers that be to mobilize to protect the big hedge funds from this, right? It just shows you kind of the prioritization that we have as a society right now. It's crazy. Right. So I got several other questions to ask you, but yeah. As you react to that, last point on the topic, or last question on the topic we're talking about, how big of a game changer do you see what's going on right now is? Is it just sort of the phenomenon of the week, or do you think it's going to have long-lasting implications?
Well, the reason I went through that, the technology, the zero commissions, the fractional shares, and then Buffett and the work from home stocks and, Tesla and the like, is this didn't start last week. This has been building for years. And this is just the latest iteration of what we've seen. So I think this is a big thing that's going to go on. And ultimately, it can be a little bit more healthy because you will get back to kind of a market we had 40 years ago or 50 years ago, where it was more people discriminating about buying a piece of a company as opposed to buying into a product like an active manager or an index that indiscriminately bought everything. That ultimately, I think that would be better in the long term than what we have right now. It will help capitalism work a little bit better. But yeah, I mean, it might, two things can be true at once. We could be going through this tectonic change where retail investors have been given the tools and the low cost that they can do it themselves and compete with the big boys. And we can also have a peak at the same time. So two things can be true at once. It doesn't have to be an either or type of situation with it. And yeah, I do think that when you look at the valuations, that it is kind of, it is, very vulnerable. Like I said before, valuations tell me we're vulnerable. They don't tell me when. These type of instances that we're seeing with what's happening with all of this mania on mania with retail investors might tell us we're getting closer. But again, it still doesn't tell me when. But I don't think it's going to be that much further off.
All right, awesome. And we're running over here, but this is such a great conversation. I want to keep it going for a few more minutes longer, at least. And thanks so much for giving us so much time and great insight here. So, talking about current market valuations, how the landscape's changing, as you look forward, because that's really your role at your research firm, is to look forward and try to figure out, what the landscape's going to evolve into. What do you kind of see going forward as broad strokes here? We just had the Fed conferences yesterday. Both Jerome Powell and newly appointed Treasury Secretary Yellen, who used to be a Fed chair, both seem very content to keep the monetary and fiscal spigots turned on for, as long as they think they need to. So I guess the question is, what do you see going forward? And if it's going to be very influenced by stimulus, monetary and fiscal, are there limits to what stimulus can do? Can they prop these markets up forever, or at some point, do their weapons become less and less effective in trying to support today's prices?
I think that 2021 is going to be about one word, and it's going to be about the word inflation. And I'll give you the scenarios. Scenario one is we get inflation. I'm in this camp that we're going to see more inflation as we move forward. Why are we going to see more inflation as we move forward? As I kind of teased before, we've been mailing people money. First, we mailed you a $1,200 check. Then we gave you an extra $600 a week in unemployment. That was in the spring. We had the PPP loans as well too. Now we've mailed everybody a $600 check. We're giving you an extra 300 weeks of unemployment. Currently, we're discussing whether or not you're getting a $1,400 check coming in the mail as well too, and maybe extending that unemployment all the way through the end of September. A lot of people say to me, well, Jim, you can't get inflation unless you have wage inflation, and there is no wage inflation. And I was like, well, write it big. There's another statistic that's called personal income, which is all your income, your wages, your stock market gains, the gains from your house, Social Security checks, whatever. 20% in 2020, 20% of all of the income Americans generated was mailed to them by the government. Not only was it the highest level ever, far and away the highest level that we've ever seen.
That is amazing.
If you're going to keep sending people money in the mail, they're going to do something with it. What are they doing with it now? It gets back to our previous conversation. They're afraid to spend it because the economy is not doing that well. So they're saving it, and that savings for a lot of them is in a Robinhood account, and they're running with that. Well, eventually, let's just say eventually, COVID will pass. The economy will start to open. I'll get to go back to Wrigley Field because I'm in Chicago. I hope soon this season as well. And we're going to have all this money and we're going to spend it. So story one is when we start spending it, we're going to see interest rates move up. We're going to see inflation move up, followed by interest rates moving up. The Federal Reserve, if they think that the answer to higher interest rates because of higher inflation is to buy more bonds and suppress interest rates below the inflation rate because of rising inflation, that will end badly. I've used the analogy, the Fed is a post in the ground. The market is a horse tied to that post. It stands there because it's tied to the post. And the Fed gets what they want. They want the horse here. They got it here. They put the post down and they tied the horse to it. But that horse is an 1,100-pound animal. You spook that horse. That's called inflation. It'll rip that post right out of the ground and it'll do whatever it wants to do. So if the Fed thinks that the answer to higher inflation is that they are going to try and suppress interest rates from rising, I think that will end badly. That's my scenario, that over the year, we're going to see higher inflation. One quick word about inflation. If we get, let me use the Fed's favorite measure, or one of the Fed's favorite measures, core personal consumption expenditures, core PCE. That's one of the measures they like. So I'll use their measure. We get 2.6% inflation. That is a 28-year high in inflation. 2.6, come on, that's not inflation. Well, it's a 28-year high. It's a good place to start. So when I talk about inflation, give me 2.6, give me 2.7. I'm not saying give me 7 or give me 6 or 5. I'll worry about that the next year, the year after. But start with a 28-year high in inflation. Now the Fed says, oh, but we'll tolerate 2.5% inflation. It's not your call. It's the market's call. If the market, that horse, doesn't like 2.5% inflation, it'll rip that post out of the ground. In December of 2018, Jay Powell comes out and says, we're going to reduce the balance sheet by $60 billion a month. It's going to be an automatic pilot. It's going to be watching paint dry. The market rioted, sold off 20% during the fourth quarter of 2018. 10 days later, we had the so-called Powell pivot. Oh, we're going to be patient and flexible. Last year, almost a year ago today, actually it was a year ago today, the Fed had their meeting. We're at 2.5% on the funds rate. We're going to stay here. I see no reason for us to move rates. 14 days later, they cut rates 50 basis points. Why? Because the market tanked as we became aware of the impact that COVID was going to have. The last two Fed changes, we were 14 days away from the Fed changing once the market decided it was time for the Fed to change. So if inflation keeps going up and interest rates start to object to it, eventually, and if the Fed tries to fight it and they start creating problems in the bond market, it will force them to raise rates at some point down the line. That's if we get inflation. I said 21 is going to be the year of inflation. Let's say we don't get inflation. Let's say that the people that said, look, Jim, we're not really stimulating, we're just filling a hole that we created from COVID. Okay, we're filling a hole we created from COVID, fine. Then you mailed me $1,200, you mailed me $600, you mailed me $1,400. You gave everybody all this extra money in unemployment benefits, and all that money went into the stock market and went up. So what was the consequence of all of that money mailing, as I like to call it? Not money printing, but money mailing. The poor got something. Yeah, you could quibble that maybe it wasn't as efficient, but they got something. The unemployed got a bridge. And the rich, let's define the rich as stock investors, they got new highs. Everybody won. So why are you going to stop doing that? UBI, universal basic income, and modern monetary theory will become the order of the day. As soon as we're done with the $1.9 trillion package, we're going to do infrastructure, which is going to be more spending. And then we're going to look around and go, let's say, Jim, you were wrong. There was no inflation. Let's mail some more money. And then we're going to look around. There's no inflation. Let's mail even more money. And so there's no way we're going to ever say, look, we mailed everybody money. Everybody won. Nobody lost. But we're not going to do it anymore. Especially with a Democrat Congress, we're going to definitely keep doing that. So that's why I say it's going to be the year of inflation. Do we get it? I think we do because of the money mailing. Or don't we get it? And if we don't get it, we're just going to then welcome UBI. We might as well, bring back Andrew Yang and Stephanie Kelton, the big proponents of UBI and modern monetary theory, because they're going to be running the show as far as we go from here. So one way or the other, I think the story this year is going to be about inflation.
Okay, so you have probably freaked out a good percentage of the viewers of this video for a variety of reasons. But one big one is I think a lot of them share a skepticism, a concern, a fear of further erosion of the purchasing power of their cash and their savings.
That is inflation. That's what inflation does.
Exactly. That's what inflation does. So. Yeah. And just to be clear too, we've had a number of guests on in recent weeks and months who are coming to the same conclusion as you, and they are, like you, very smart, very experienced investors. I'm talking about people like Steen Jacobson of Saxo Bank, Grant Williams, Jim Rogers, et cetera. So, you're validating a lot of what we've already been hearing. So for folks that are concerned about a potential year of inflation, you spend your time doing research and then advising investors. What advice, what recommendations to viewers that are watching and are concerned and are looking towards their portfolios? Do you have any advice of asset classes or strategies that they should be considering at this time?
Well, there are a bunch of inflation beneficiary strategies that have been doing well. Of course, well seems to be paled in comparison to GameStop. They give. You can be looking at gold, you could be looking at silver, you could be looking at commodities or maybe commodity producers. basic material stocks, that kind of stuff. If you're into ETFs, there are a bunch of ETFs that are tied to commodity indices as well too. All of these do better as inflation returns, and they have been doing well. They've been doing much better than the averages over the last several months, and I think that they will continue to do. Within the stock market, I would be away from things like the financial stocks, but I would be more towards the basic materials stocks. I'd be more towards the industrial stocks and the like. I think that they will do better. Quick word about the stock market itself. There's a myth, the stock market's the greatest inflation hedge because as the raw material prices go up, they can raise the price of their product. Yes, but they can never keep up with their margins. And that they wind up losing in the long run, companies, when you have inflation. That's why in the 60s and the 70s, the stock market was a very poor inflation hedge for everybody. Commodities were a very good hedge. If you could drop it on your toe, it's a good investment if you think that you're going to have inflation. And just kind of put it in those terms as well.
All right, great. And just to make a note to Wall Street bets with driving GameStop to all-time highs, there is a lot of chatter on there over the past 24 hours about certain silver mining producers and just the silver market itself being heavily shorted. And there's now kind of a groundswell campaign to say, hey, let's all start buying silver. Maybe let's actually try to take delivery, from COMEX and try to see if we could crash the system. I got to say, I have no idea if that's going to happen, but I'm selfish here. I'm rooting those guys on.
Can I make a quick word about that?
Yeah.
If it works, and like you see the price of silver or gold soar, kind of like GameStop soar. Bring it on. I'm with you there. What it means is that they were right in that Wall Street's positioning was all wrong, but nobody wants to ever call them on it. So they're allowed to have these wrong positionings until this new crowd comes in. If they're not right, you'll get a modest rise in silver as they buy, but it won't be anything significant, but it'll still go up. But all I'm trying to point out is, what is the takeaway if all of a sudden it started to look like GameStop's chart? It means Wall Street had that positioning wrong too, and that they were exploiting another weakness in Wall Street with their short in a lot of these metals. And we'll find out real fast whether or not they do have that positioning wrong. We know they did in GameStop, and we know they did in a lot of these other crappy companies that were near bankruptcy as well too. We'll find out if they did in the metals real fast.
All right. Well, look, I'll try to be real quick in limiting your time here, just a few more minutes. You've been so generous with it. I just wish we could go on for another hour or two, and I'm guessing maybe a lot of viewers wish we could too. I think people really are probably, your words are resonating with them about inflation, commodities, material companies, producers, et cetera. I know a concern or an issue that they're wrestling with is, okay, so do I deploy into them now, or are the markets so overvalued that, I could get into these companies, but there could be a general market decline that at least for some period of time brings market valuations down? You mentioned probably 20% or more, Jeremy Grantham saying 50% or more. So it's kind of the question of, do I wait for a correction and then enter, or do I start entering now? This is not financial advice that you're offering. I want to make sure that's clear to everybody, but do you have sort of an opinion on people wrestling with that concern?
A lot of what's driving the valuation of the overall market being so high is not these stocks. It's a lot of the technology stocks. It's a lot of the healthcare stocks. It's a lot of the retailing stocks that pretend they're technology stocks. Amazon is technically a retailer. It's not a technology stock. Those are the stocks that are vulnerable. If you look at the spectrum of valuation, when you start getting down to the basic material stocks, the industrial stocks and the like, they're not as extended as the rest of the market. And I'm not going to tell you they're cheap. It's hard to find cheap stuff in this market right now. But if the question was, what stocks would I most want to hold if I had to hold a stock in a correction, it would be these stocks, because their valuations are not screaming that they're going to get walloped like a lot of these non-profitable tech stocks are going to get walloped. Don't confuse this with Tesla, because in the next turn down, when you've got a barely profitable electric car maker that's bigger than every car maker on the planet combined, they're going to have some issues on the next downturn. But that's not going to be the same as the junior gold miners. They're not going to have the same issue. So I wouldn't be as concerned about that. Look, if you get the timing wrong and you buy these and the market goes down, you get the timing wrong. If you're worried about timing, then we go to talk about, timing the S&P 500 index fund, because that's essentially what you're trying to do. And don't try and then nuance it to buy these gold stocks. So if you like this idea, you've already got that natural protection there because you're buying them fairly cheap relative to everything else. If you're going to time it, then go all in and just be a market timer and don't worry about some of this other stuff.
Okay. And we're probably united in the opinion that most average people shouldn't try to be market timers. It's just, it's a fool's errand in many cases for people who don't follow the market.
I'd like to say about market timing is I think that there's people that can do it. It's a full-time job.
Exactly.
Now, do you have no job and do you have 45 hours a week to devote to it? If you do, be a market timer. Now, if that's not what you do, don't be a market timer. You can't do it part-time. You've got to, it's a full-time job if that's the business you want to get into. And virtually nobody wants to be in that business full-time, nor should they.
Great. And that's a great segue into, after we let you go here, Jim, I'll be finishing up with the guys from New Harbor Financial who are on here every week, who are financial advisors and do have that 50 plus hours a week to be watching the markets and whatnot. So, basically, I think we're probably united in the look, for most people who can't track this stuff, come up with your strategy and then find a good financial advisor whom you trust, who understands these risks that you've been talking about, to actually put a plan together and implement it and watch that for you. All right, second to last question as we wrap up here. I just want to recognize the tremendous amount of valuable work that you did in the first half of this year, educating people about the coronavirus pandemic spread as it was unfolding, and the information was emerging, and people were just really casting about for just good insights. And you were a really good source of well thought through, well sourced information on that. It's something you and Chris, I think, did just a huge public service to many, many people through that. I don't know if you're writing as much about coronavirus these days, but is there anything going on there that you think is notable for us to talk about before we let you go?
Yeah, I've been really focused a lot more on the pace of the vaccines. How many people have gotten the first dose, the second dose? What is the pace of the vaccines as well, too? And the one thing I'll point out is that the country of Israel, now it's not a big country, about the size of New York City, country of Israel is now vaccinated about 40% of its population, 40% of its population. But if you look at the Johns Hopkins data on infections, it's not really coming down yet. And I'm wondering if that is giving us a good sign for big countries like the US. Okay, what do we got to get to in order to start to really see some kind of decline in the amount of infections? Now, I'm leaving aside whether or not we get a mutation, or we get the South African mutation or something, and that changes the game. That can always be the case. But just leaving that aside, what do we got to get to? And if Israel's at 44%, and they're not quite turning around, does that mean we in the US have to wait until we get to about 110 million people vaccinated? And that's 2-dose vaccinations. We've only got about 4 million people 2-dosed right now. We got a ways to go. It could be the balance of the year if that's indeed the case. So that to me is the most concerning thing that I've been looking at, and trying to watch the pace of the vaccines a little bit more as we move forward.
Okay. That is sobering. Obviously, we want these vaccines to be making a huge difference. Still really early in the game. So, caveat this, that we're looking at a data point of 1 countrywide so far with Israel. But I think to your point is, since we have that data point and it's showing no demonstrable reduction yet in the incident rate of cases, we have to leave ourselves open to the possibility that COVID may not be dying down as fast as we would all like. And that has obviously social implications, but it also has implications for the markets, et cetera, right? The markets at their current prices are, basically presuming perfection in terms of rapid return to business as normal. And this could definitely be another monkey wrench that gets thrown into the works.
as I said in the beginning, everything on Wall Street is always a good idea taken to its extreme. And the valuations on the market are the good idea that, hey, we're going to have a reopening in the economy. Yeah, okay, we're going to have a reopening in the economy, but you've taken it too far. And you better have that reopening soon if you're going to continue to be at these kind of valuations. Or to put it in another way, President Biden keeps talking about his 100 million shots in the first 100 days. Even if we beat that number, and it looks like we're going to beat that number, it's got to be a lot more than that. If you will, I like to put it personally, like how many doses do we have to get out there before I can buy a ticket to go back to Wrigley Field? And it ain't going to be 100 million. It's got to be a lot more than 100 million. And so we're going to have to hopefully see that gets ramped up and that gets moving. And again, this all assumes that there's no monkey wrench thrown in there, that here comes some kind of mutation, that either the vaccine doesn't work or that it becomes more contagious or something like that. I can't predict that, but I can say that what we need to do is if we are all ready to go, I got friends that seem to think that that's it, the vaccine's here. The first day, because I live in Chicago, the first day we get back to 70 degrees, we're going to be out there and going, hold on a minute, time out. If we don't have enough people vaccinated, it's going to look a lot like last spring. And you're going to be very, very disappointed unless we start ramping these numbers up here real fast. So we'll see what happens with it.
Okay. Well, Jim, this has just been an absolute pleasure. Just insight packed. I cannot thank you enough for your time, for your expertise, for your articulate explanations. Really hope to have you back on again in later in 2021 so we can see what's happening as things evolve here. As I'm sure a lot of people have enjoyed this as much as I have, for folks that are interested in learning more about you, following you and your work, where should they go?
Start with Twitter at Bianco Research, or my website, biancoresearch.com, or you can follow me on LinkedIn at Jim Bianco. Just search for my name. Those are three good places that you could start and kind of go from there.
Great. And Jim, in the editing process, I'll put up an overlay to those URLs so folks can easily find them. All right, Jim, thank you so much again. We'll let you go here and get back to your important work, but really just what an honor. Thank you so much.
Thank you.